Probably the most topical thing at the present time is the inversion of the yield curve that happened on Friday, March 22nd. And what does that mean? Well, that means that bond yields, like 10-year bond yields, what everybody watches is kind of the benchmark, both in Canada and the US, are at a lower yield now than what you can get on a 3-month Treasury bill yield. So what does that mean? Well, in the past, that's been a signal from the bond market that you're going to have a recession, generally anywhere from about 4 to 14 months, and on average, going back to the 60s, when you've had this inversion of the curve last for more than 10 days, you've had a recession every single time. Something that's batted 1,000 the last 50, 60 years is probably a good thing to still pay attention to. So it's not surprising that investors are a little bit more anxious about their outlook at the present time. It tells you that bond investors think that growth is slowing. It tells you also that they think that inflation's not a problem. And it also tells you today that they probably think the Fed went too far last year. Recall 2018, the Fed hiked rates 4 times. We're also shrinking their balance sheet to the tune of $30 to $50 billion per month. Cumulatively, that was a bit of a problem. As we all recall, the fourth quarter saw stresses in the stock market. The S&P went down about 20% intraday in Q4, and the TSX went down around 17%. Now, both have had greater than 12% returns so far year to date, so they've bounced nicely. So they're not telling you that there's any big worries as far as that goes, but stock market's not generally the best indicator of a recession coming. The bond market and the inverse curve is a much better track record. You're not seeing confirmation of stresses that we see sometimes in the past also. You're not seeing the 10-year go below the 2-year yield yet in the US, which always happened before the 10-year went below the 3-month yield. So you don't see that. You don't see financial conditions indices. Goldman Sachs has a famous one people follow. It's not flashing any stresses. And you don't see stresses in the corporate bond market either. Credit spreads are very well behaved and actually are tighter today than where they were a few months ago. So some of these factors that you'd be looking for confirmation about a recession aren't there today. So maybe we're going to see a resurgence in growth in the second half that'll alleviate some of these recession fears. We'll have to see. What we've done so far in our portfolios is we've seen a good rally in the bond market so far year to date. So we've reduced duration in some of the portfolios as these yields have just gotten a little too low, we think. So we think we could see yields back up a little bit on some better economic data that may come down the pike in the second quarter this year. And we're also avoiding the most expensive area of the yield curve, the 5-year area, looking at 2 years, 10 years instead, putting bonds in those places where the yield's a little higher and we see potential better returns. If we see the 10-year go below the 2, if we see growth continue to be sluggish in the second quarter, then our fears that a recession is going to happen late 2019, early 2020 will cause us to make some other changes, but we're not doing them at the present time.